Hey folks, as I am an aging investor and my portfolio continues to scale, I become less and less concerned about the value of the portfolio itself as much as I care about the holdings that comprise the components between the ETFs and individual stocks, because I know if I make the right decisions, the value regardlessly should go up over time. And I only share with you guys the value because I truly believe that you'll get inspiration from watching myself do this. And even today, logging into my accounts, I was quite shocked about how much my portfolio was up. And it's really no shock when you look at the XEQT, a global market ETF that is now at all-time highs. The S&P 500 is only 1% away from its all-time high, and it's crazy how aggressive we got in April. And within 2 months, the S&P is almost fully recovered. And if you just cost averaged or got very aggressive like I did, which you can go back and look at those videos through April, you would have seen an extra 10 to 20% return on anything you bought through that period. Literally within 2 months off an S&P, the 500 largest companies in the United States. This is an index, and it returned 10 to 20% from any invested capital here. So congrats to anyone that got aggressive during the tariff war. And even on the Canadian side of the border that has been crushing the US markets this year. I mean, VDY, my monthly paying Canadian dividend ETF, is now up almost 1.5% from its last peaked all-time high back in 2024. And very similarly, if you bought the dips here, you could have seen anywhere from a 10 to 20% gain on a Canadian monthly paying dividend ETF. I mean, these returns are just astonishing and obviously do not represent the forward-looking returns, because obviously this can all be taken away at any time. But as a long-term investor, I do not get caught up in the short term. But I think it's prevalent today to talk about my 3 major bets. There's a lot going on with these stocks, and I thought it would be appropriate to update it. So if you're on a path to financial independence, if you damn well one day want to retire early, join me by hitting that subscribe button, because a lot of people in my chat group, a lot of people in my comments that watch these YouTube videos are taking into consideration Google stock. I see a lot of you buying it, and I do want to assert that there's an incredible amount of risk that we're taking on with the stock, which is why it's priced at a 19 times multiple. I mean, this is the cheapest value Google's pretty much traded at in its entire history, with the exception of 2012, which is kind of crazy to consider. And even on the back of what an incredible growth rate it's been on, I mean, since 2023, it's almost doubled its earnings per share, which is insane enough. But investors are sitting here with major concerns around the fines and what is going to be the remedies from the monopoly court cases that have finalized. They've been convicted, and the remedies are going to come out in August. And next month, in July, just before the remedies, we are going to get earnings, which I think will be a defining factor to search results, search revenue generation from ads. And we're also going to get a look into seeing how Gemini VO3 and this new suite of software and their AI assistant are actually seeing an adoption at a mass scale. And if they are seeing an adoption at a mass scale, I think it could be a very bullish sentiment and a shift from search to subscription-based services, especially with the integration of Android and Gmail and all the suite of stuff they have that can integrate that AI into those different suites of products that they offer. But I do want to share with you that I'm still obsessed with Gemini itself, and I've been using it quite relentlessly. And I'm finding the weird thing about it now is I'm using search less, and I'm using the AI video tool that Google came out with for free. And maybe let's take a look at this real quickly yet again. So here's Gemini, taking a video of myself. Hello, Gemini. Hi, Google. It always takes a sec.
Hey there. What's going on?
So let me turn you up so these guys can hear what's going on. But I've got a list of stocks here, and I was curious to what one is your favorite.
Out of all of these stocks, I would say that Google is my favorite.
Now, I know you said Google is your favorite. I'm not looking for financial advice here, but for entertainment purposes only, for what might offer the best returns, what stock would you pick on this list?
Out of these options, for entertainment purposes only, I'd say Meta Platforms, Meta, might offer the best returns. It's showing a pretty solid gain. But remember, this isn't financial advice.
Wow. So Google threw its own self under the bus to tell me to buy Meta stock. Like, I love playing with this tool and the accuracy that it has, and the fact that Siri is garbage and delayed. This thing is spitting out information like that. Like, once that sucker's up and warmed up and running, man, it's just like a constant, instant conversation. And I am just ever impressed. But I'm glad that it picked itself first. And I was like, you know what? Meta's looking pretty good here, boys. And speaking of Meta, this one, I'm going to tell you right now, I don't think it's trading. I think it's favorably valued. I think it's trading at fair value. I think it deserves between a 25 and 30 times multiple. And like I said, if you're buying it today, I think it's a great buy. But the real value is when this thing dips, because it goes through insane volatile moments. As many of you OGs that have been around for a while, back during this era here, which if we take a look at the actual price to earnings, historically, if we kind of wipe out the 2015 era when this company was at a huge growth phase, as it's matured into the $1 trillion market cap realm, it historically will trade somewhere between a 30 and anywhere from as low of a 13 to 12 PE. Now, I don't think we're ever going back to a 12 PE, at least in the near term, because that was off the back of the 2022 interest raise and inflation cycle, where earnings were deteriorating because the company had so much CapEx expenditures. And obviously, this was a period where people realized that investors wanted to see bottom line earnings, and the company shifted from lowering their CapEx. But now, because earnings are exploding again, they're re-expanding their CapEx toward obviously AI, cloud computing, hiring the best talent, trying to, sign on bonuses of $100 million. But we can see right now at a 27 PE, this is actually a very nominal PE throughout its history. Usually it'll trade between that 25 and 30, with major dips opening up, those rare opportunities where this was a true buying opportunity. And I sold Google right around this 220 era because I recognized that I didn't know what the future looked like. But my wife had the foresight to just hold on to this and ride it all the way down to like $100 a share, as she laughs at me today where the stock price currently sits. But yeah, I didn't want the overexposure because we both had a pretty hefty position in this, and I shifted a lot of my individual stocks to ETFs at this time. And now more recently, as you guys know, within the last year, I have been starting to load back up on some individual stocks that make up no more than 20% of our combined portfolios. But keep in mind, that's the combined portfolio value, not our total asset value, because we do own a sizable piece of real estate here in Toronto. And I noticed some people were calling me out for saying, you said you would never make an individual stock more than 5% of your portfolio. But I do want to iterate that our asset value it's quite sizable between all our different assets. So I don't mind if it's in my portfolio at 10%, knowing between all our assets it's probably well below 5% still. But nonetheless, it's something appropriate that I still believe to this day, that you shouldn't make an individual stock 10% of your portfolio unless you're in your 20s. If you're really young, you have a long time horizon, go for it, right? But getting back to it, look at introducing of the Oakley Meta glasses here. I was quite impressed that Google's continuing to try and merge the VR that I got back here into the glasses, and this has been a struggling market piece for them. I think there's way more congruent, quick to market value with AI, which is why Meta, Google, all these companies are leaning so heavily into it, because it's instantly converting value, whereas this stuff is just costing a god-awful amount of money with no real instant value of growth, in my opinion. But let's just take a look at some of the updates with the Oakley here.
Hey Meta, how strong is the wind today?
The wind is blowing 12 miles per hour from the northwest.
Yeah, I got that.
Hey Meta, take a video.
No, I hope this isn't getting copyright, actually. I'll turn it down here, but we get the idea. They already had the glasses. They're obviously just upgrading the suite, so it's more interactive. I could see this being used by people that like to wear glasses pretty regular. I'm not a regular glasses wearer, so this doesn't really fit past like my iPhone or my watch, and I'm very disappointed that Apple's basically been lagging this entire game. Like, Apple should have made Siri what Gemini is today. And it really bothers me that Gemini can't integrate and actually utilize all my Apple apps. And maybe it does if I pay for the advanced version. Let me know if that's true or not. But yeah, I think these companies are all kind of playing this, how can we integrate AI into something to capture some market share? And again, I like owning the suite of these companies because I think they're all going to go through this massive upgrade. But I'd still like Meta and Google the most for this play. Meta, I think, has the least amount of risk, but you're not paying a cheaper value. Google has a lot more short-term risk. You're getting a much cheaper value for that AI. And these are my primary two AI picks personally. Like, they're direct AI players. Microsoft is kind of competing right now for OpenAI. There's a lot of drama around getting ownership over that, and OpenAI is claiming that they've taken Apple's lead designer for a lot of the Mac products, and they're trying to obviously scale up their own product that nobody really knows what it is. They've been very mysterious about it, so we'll see if it's just a pair of glasses. I don't know if it's going to be, I doubt it's going to be a watch. Who knows? We'll see as time goes on. But finally, those two major picks, these three stocks in general, are our primary focus. Cost average to the many. You always want to focus on the many, make sure money's always going to the broader ETFs, but if you can focus on the few, the things you understand, you tend to make money. I've always made money on things that I believe I truly understood, and this is one of them. I am a gamer at heart. I play VR religiously. I still love Grand Theft Auto, and this is why I, for the first time ever, actually scaled down some of my S&P which was quite funny when I did this because, as you might recall, back in February, if we take a look at the year to date, I think it was right around here somewhere, I actually sold my S&P shares because I just wanted to quickly get a sizable position in the Take-Two. And since I sold those shares, the S&P has only just started to recover. But Take-Two, since I did this after their earnings on around February 11th, I'm up pretty sizably, like anywhere from a good 15 to 18% depending on the account, because I did buy some cheaper shares that I cost averaged in at around 208. So I've seen quite a sizable return in the same time frame comparably to the S&P on this position. That doesn't mean it's guaranteed by any means. I mean, we're all patiently awaiting, and I was really disappointed by the delay. And my thesis remains the same. I think people and analysts are severely underestimating the growth potential of GTA 6. I think it's going to generate 50 to 100 million copies sold at over $100 a share. I think it's going to immediately generate an ungodly amount of money, bolstering their bottom line earnings somewhere between 3 to 5 billion in probably 1 or 2 quarters. And it's going to completely justify the value here like overnight. And I think it's going to probably trade at maybe a 15 to 20 times multiple, putting it closer to probably a 60 to 80 billion dollar market cap. So if we get there preemptively, like if we run from a 40 to 60 bill market cap long before this game comes out next year, I'm probably going to exit the position. I might keep a little bit just to see if the hype really can drive the stock much higher. And I'm holding this comfortably now at the overvaluation it has because it doesn't make positive earnings. This company dilutes us like crazy. But if we take a look at the statistics, the thing that's keeping me in this right now is the fact that it's got a like 96% institutional, ownership. Basically just meaning, hey, there's not a lot of public shares out there. Institutions are hoarding this. It's one of the most institutionally held stocks on the S&P. Just meaning if any retail dives in this, the stock price could propel quite easily. And I think that's what we're seeing now. So, if we take a look at anything else when it comes to this company, there's no metric that's appealing. Like their balance sheet's not great. They're diluting. They have no earnings. Like everyone's like, why would you like this company? And because I don't believe in the past, I'm always looking forward. If a company has fundamentals and a good forward-looking basis, I'm ever happier. But you can't help but recognize that this thing is going to sell an ungodly amount of copies, and it's going to print just like stupid amounts of money, like enough money to justify its $40 billion market cap today, at least. Because the hype, it's the most valued piece of media entertainment ever. It cost more money and took more time, it cost less money and took less time to build the Burj Khalifa. I mean, they've been spending billions on this game. So, there's nothing material other than the only underlying fundamentals that give me some hope in the short term that keep me in the stock is the fact that they have a lot of games coming out right now. They're still generating, they expect to generate record revenue just off the current lineup they have. I think somewhere around $5 billion in revenue this year. So I'm very comfortable with where they set at the revenue they're generating. So fine, so be it. I'll let these games kind of marinate, and then let Grand Theft Auto be the cherry on top of the cake that takes us to the moon. And I hope to make about a 50 to 100% gain. I'm already up 20%. So like I said, if I can hit my targets, and this is a short-term trade, I have entry and exit prices. If this hits my short-term, where I want to see the stock go, yes, I'm going to take that profit, and I will be pivoting that capital into probably the ETFs or anywhere else I see some value. This is my shortest term trade. Google and Meta, I will take profit on these. Keep in mind, these are sizable positions. I don't know at what value. If they keep running up and we see considerable gains, I will scale them down, and I will continue to transition the value into ETFs. It's always the game, right? Take the quick gains that outpace the S&P and take those profits and always slowly put it toward wealth preservation. But again, this is the strategy that I've been implementing. This is relatively new. If you've been following this channel, it's been a slow evolution to this point, getting rid of SCHD, really building out the 3 ETFs with VOO and VDY being relative core, but VOO is the core. It makes up 50% of our combined portfolios. VDY is a little bit bigger, and XQT is just a new one that I started, but that's just to get some global exposure. And over time, these will scale. And yeah, it's a fascinating world we're living in, and I feel very comfortable with my portfolio as it is today. But I'd love to know what you guys think about all of this in that comment section below, and just the stocks you're buying, where you see the most interest, because there's a lot of great stock picks out there. But again, I want to keep my focus on what I understand, and I believe I understand these 3 companies very well. But on the note, as always, I look forward to catching you in the next one.